Some people embrace long-term planning and strategies very, very quickly. Some people never even think about getting started, and other people have tremendous fear.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
Hello, it's John Smallwood back on Money Isn't. I recently was down in Florida visiting my mother, and I was going through some of my old business partner stuff, my father, John P. Smallwood, and stumbled across a bunch of charts that are about 10 years old and a lot more data than what I was doing in the last one. And I thought it'd be really powerful to share some of that information. But before I do, I kind of want to, there's certain things that go on in financial services, in the wealth management space, in wealth accumulation, in financial planning, that is really interesting to me from the standpoint of some people embrace long-term planning and strategies very, very quickly. Some people never even think about getting started, and other people have tremendous fear about getting started. And everything that we do in Smallwood Wealth and the Wealth Curve, blueprinting, is really designed to get rid of the fears, to help you get started, and to make sure that we have fail-safes in place and we have backstops and we have liquidity and we have all those things. But it's really, the success of a financial plan really comes down to the actions that you take today and that you repeat them over and over and over and over again. And if you don't repeat them over and over again, assuming those are the core strategies, then you're probably not going to get to the destination that you want to be in, okay? And if you're watching this on the YouTube channel, you already see it. If you're listening to this on your favorite podcast medium, over at the YouTube channel, I'm going to have some visuals. So my father, looking into some of his stuff and cleaning out some of his old stuff, made me think back, right? And it made me reflect a bit on our journey of creating this wealth management firm and now having, multiple advisors, kids in the business, partners' kids in the business, and really exponentially going to the next level. It made me think of something my father used to say that I didn't really understand. And he said, when you buy some piece of equipment, there's typically an instruction manual that comes with it, right? And you could just take it out of the box and you could start using it. And some people are quick to adapt, and you could see certain people that are able to do that. Other people read the directions, and other people read the directions after they fail, okay? But he said money doesn't come with a instruction manual. And I started to think about it, and I used to go, yeah, right. And you talk to some really, really smart people who have incredible educations and degrees, and they said, I wish I had a class like this when I was in my graduate program or in college. And we never had any of this instruction manual. So part of what we do in its complexity of all the different financial factors that are hitting and touching and pushing upon your wealth is if you could create an instruction manual that would allow you to go to and troubleshoot when you were doing it, or to recall and kind of get you out of the trap that you're in, you would potentially be much more successful, okay? And that's sort of what it is. Now, one of the previous podcasts, I like to use these charts that are put out by JP Morgan Chase, and I'm going to go through, I'm going to show them to you. But what the phenomenon has been is you get less and less data on these charts, so that the true meaning behind what these charts are and what's happening is getting lost, in my opinion, because they're working with a more narrow frame of information, and you begin to see more as you expand the lens and you kind of view out, you get to see a wider picture, okay? So when we're looking at, money over a long term, most people's belief is that money is a mathematical set of money accumulation is math. And money is not math because it is subject to erosion principles, which we've been talking about on an ongoing basis. And we're not going to dive into that in deep, but that was on another thing. But the key of what I'm going to show you and the goal of what I'm going to show you is to provide confidence. And that if something is normal, then if it's normal, then it's simply noise. But most people are going to tell you, well, it's just noise and you need to ignore it. But I'm feeling a lot of pain in the moment, is what I hear often from people that are coming in to the process. And the idea of a really well-designed financial future and a financial plan is that there are structural elements and components that are here in the plan designed to not participate in up or down markets, to simply make small rates of return. It's that foundation. Think of it as a foundation. What I'm going to be talking about is above the foundation today, meaning this is building the engine in the business. It's building the structure that really is going to make this financial plan sing and win, okay? And win, okay? So this chart is basically 44 years of financial data, okay? The black represents the ending market close, and the red dots represent an intraday, intra-year volatility, an inflection point where the market hit the low point in the market, right? So if we just focus on 1980 for a second, the market at some point during the year was down 17%, and it ended the year up 26%. And when you look at, for example, 2008, market was down 49% and ended the year down 38%. If you focus on the following year, which would be 2009, pretty much March 9th, I know that that's burnt in my brain, market was down another 28%, but it finished the year up 23%. What I see in the chart is when you look at it, the chart says, despite average intra-year drops of 14.2%, annual returns were positive 33 out of 40 years. And somehow, this is supposed to make you feel good. And years ago, one of my first clients that was very successful that said, John, yes, I want to work with you, and really embraced what I said. We were managing a portfolio for him that there was a thing called the Asian contagion in the early 90s where, 97, summer 97 to maybe summer 96 to summer 97, where the markets were down like 30-something% over that time frame. And we had a portfolio that was well diversified, and we were down, let's say 23%, and the market was down 26, 27%. And he said, John, I get it, but is that supposed to make me feel good? And I said, yeah, it is, but it doesn't, right? So, and that was something where we start to take a look at this and say, this being down 33 of 40 years, but every single year, if you look at every single year, there's a red dot. There's a spot where it was negative. It was negative every single year. So if negative happens every single year, I need to develop a plan and a structure that's going to smooth that ride out, because emotionally I can either take it or I can't, okay? And I'm going to talk about other financial pressures and how volatility adjusted returns beat on this, etc. But what's interesting is I uncovered this piece from the Capital Group, American Funds, digging through my father's stuff. That's, if you look at the side of it, it's data through 2013. happens to be the S&P 500, same type of thing, and it's entitled Long-Term Investors Can Weather Market Declines. And intra-year declines in the S&P since 1946 have averaged 14%, yet annual price returns have been positive 47 of those 67 calendar years. And then when you look at the size of the downturn, there was 172 downturns of 5% or more. There was 55 of 10% or more. There was 21 of 15% or more once every 3 years. And then 20% or more once every 5.5 years. But this goes back to 1946. And now instead of looking at it from 1980 to now, this is kind of going 1946 through 2012. And when you look at this chart, the blue represents the intra-year gain, the return, the dark is the return, and whether it was positive or negative, but the gray represents the intra-year decline. And I'm looking at this again, and I'm going through this. During that 67 calendar years, there wasn't a negative. There wasn't a spot where there wasn't a negative. So whole news channels, everything has come out about why the market did something on a daily basis, right? Why is this? And I'm going to joke about this for a second, but most of it is somebody saying, oh, that's the reason why the market went up or down today. But often it's not. It's a soundbite. It's part of a bigger story. And ultimately, what the chart really reveals is it doesn't really matter, right? It matters that I was participating in that strategy, and it matters that whether or not I had the guts and the glory and the ability to get in, but more importantly, was my plan structured properly so that when this event happened, I had two opportunities. One, to ride through it, but two, more importantly, to reposition a portion of the portfolio to do something that, everybody talks about, which is to buy low and sell high, right? To take some profit and buy low. Those things are emotional. There's a whole aspect of the emotional investor that we'll spend on a different podcast. But this is, I wanted to share this with you because I felt that this information, if I compound it now another 10 years, it's 77 years when you combine the JP Morgan chart and this American Funds chart of negatives every single year. So it's normal. It's 100% normal. And I should just expect it to be part of the plan. And when I expect it to be part of the plan, I'm not focused on short-term intermediate moves. I'm focused on my strategy and my long-term plan. Now, we spent a lot of time recently talking about this asset class returns. And the asset class returns, we have to realize this. We're all in what we call the rate of return Olympics, meaning, what have you done for me lately? Why have you performed or underperformed? And when you read all the studies, most actively managed mutual funds don't outperform the S&P on a consistently basis or their benchmark. Some do, some don't. I'm not promoting indexing or not promoting index. I'm just saying there's a lot of information out there, but one of the biggest information is that when you look at the large endowments and the large pension funds and the ones that are successfully and well managed, they have a different time horizon, right? Because they manage their money as if it's 100-year plus money, Most individuals do not. They look at it as timeframes, and they look at it as shorter timeframes, when reality, good strategy is long-term. And it's, your focus should be 90 years, and your focus should be 100 years and growing because of longevity and other kinds of other related things. Okay. But what the bottom line is that we actually, as human beings, we make an investment in something, and our emotion, it either goes positive or negative. If it goes positive, I'm looking at my other investment saying, well, that's bad. I'm going to put everything in this. And then the cycles and the volatility change. And then it's like, oh, I should have had this. And I go chase yields, right? So it's that Dalbar study that we all, DALBAR, you can research it, you can Google search it. And basically what it finds is that the index basically performed at this. And then they take the top mutual funds and ETFs and say, over the last 20-year period, what did the average individual receive over that time frame? And the result of it is they got a spread that's usually 4 to 5% different return, because when they come in, when they leave, how they chase funds, they go from fund A to fund B, from asset class to asset class, because they don't have a core strategy. And the chart basically is taking, when you look at this chart, is taking, in this particular case, this is basically looking at the average annual return from 2000 to 2013. Large cap has a 14, large cap core, which is going to be S&P 500, has the 14%, has the best performing asset class during that time frame. Commodities having a negative during that time frame, okay? And you could see, if you follow the green through the chart, in the 2008, 9, it had pretty middle of the road volatility. The second line is the volatility. And then you get starting in 2009, which is after the 2008 crisis, obviously, right? You start to see how different things performed, and you'd see emerging markets in 2008 was the number one performer, and cash was the lagger, right? If you had 2008, you might have a different story here, right? Then you have real estate investment trusts. And what you're seeing is large cap core has been at the top of this for a very long time frame, okay? And cash and commodities and emerging equities have been down near the bottom. And people are making decisions to say, I don't want those asset classes. I don't want this balance in my plan, because I want to follow this trend and I want to be on this trend. And we all know how those trends end up. Like, trees do not grow to the sky. Things, just because I'm taking risk doesn't mean I'm going to get a return. But I found a much longer and older one. Color's a little bit awkward. It was put out by MFS Funds. This thing is dated, I believe it's dated 2015. It is, that's upside down, but it's, February 2015. February 2015, I had to lean in there to see it, all right? But what I wanted to basically go through here is that when you look at, now this breaks it down between large cap value and large cap growth. It does not have the S&P, okay? But the S&P is basically 50% large cap growth and large cap value. And I'm going to pick on that asset class for a second. But when you go through this 1995 through 2014, small mid-cap stocks had the highest average return. Large cap value and large cap growth and REITs were number 2. Large cap value was number 3. Large cap growth was number 4, and cash being down at the bottom. Okay. And when you look at this chart, you start to see that you had a whole series of times where it was up at the top back here, then it was middle, and then it was down, and it was there. But there is what you tend to see as you go longer and you look at a larger viewing scale, you tend to see that an asset class might be a winner 2-3 years in a row, then it's not. And then there's something else that's better. And then that goes away and then it comes back. It's a constantly moving cycle. And the power of what we're talking about here in the charts is that the diversified strategy, the one that balances the large cap with the mid cap and the small cap and the bonds and the cash, and it puts those together in a specific asset allocation diversified portfolio, is giving you a better, more solid foundation with a decent rate of return and less risk over time frame. And that's what you're seeing here is that diversified portfolio had about an 8.5% rate of return over that time frame, which is a big variance from the 10.3 during that time frame. And this is not putting in the risk metrics, right? So we have the volatility in this chart when you look at the JP Morgan chart. So you're seeing the return for the asset allocation is middle of the road, but the risk level is near the bottom. Okay, when you look at it it's near fixed income and it's near cash because of that balance, right? So the thing that I want to focus on is all of this. And all of these charts are really, really nice and they're beautiful and they're great colors. And, it brought back some really good memories for me to dig into my father's stuff and find that these were the charts that he felt were really valuable, and to really go through it. But what we want to focus on is that the average rate of return is not how your plan is going to work. You're going to get the actual rate of return. You're going to get that volatility adjusted return. And the greater the standard deviation, the volatility, the risk metric, the greater that gap is going to be. And I'm going to demo a couple different things here, but there was this old Prudential piece that goes back into, I believe this is April of 2013. And this one's talking about the sequence of returns. The best laid plans can change. Be prepared for market uncertainty during the retirement red zone. They're not doing this anymore, but it was basically a table on a chart showing $250,000 in a retirement portfolio where you're going to take out a 5% withdrawal. And it runs this sequence of returns where you start off with 3 years of negative versus starting off. And they're basically just taking that return and saying year 1 through 30 happens one way, and then you flip it and you just reverse. So the return you were getting in year 30 is now the return you're getting in year 1, which you have no control over the outcome that you're going to get in the future. You just simply, you experience it, okay? And in this structure, the $250,000 portfolio with the 5% withdrawal, by 16 years into retirement, you're at zero. Where if you flipped it, the 250 was still worth $130,000 at the end of that time frame. I remember years ago looking at a mutual fund ad that was in one of the newspapers. And it had if you had put X dollars in 1973, 1974 range into the fund and you took out a 5 or 6% withdrawal, you'd have a lot of money today. That was the essence of the chart. But when you looked at the disclosure of the chart, the inception date was actually 6 to 7 months prior. And I don't remember what it was. It doesn't really matter. It's the concept that I want you to get here, okay? Because all of this is concept, okay? But we used to have some software that would simulate the actual returns. And if you took the fund back to its inception date, you actually had a 30% downturn in that first 6-7 months of the fund. You actually ran out of money. Okay. So you have to be very, very, very careful with the information that you're looking at. And you have to simulate it in different environments with different timeframes and different withdrawal rates and different tax rates and different, oh shit, happens type things, right? Where I basically, this might be great. I'm having a great rate of return, and I had the proper sequence of returns, which means it was working in my favor. And then somebody comes along and says, oh, I need $30,000 because I'm in trouble. And I pull that $30,000 out, and then I have a downturn. Or vice versa, the money gets pulled out in the downturn. Those are life-changing events. So my structure here, my thinking, right, is we have the wealth curve simulation tool. And this is what I did here is I simply said, let's take $100,000. And let's assume we had a killer 30-year-old. Like this guy accumulated $100,000 outside of the 401k, like outside of his plan, and he's investing this, or she, okay? And they're really excited. And they're going to put it all in the S&P 500. And what I'm doing here is I'm looking at a 20-year period from 30 to 50, and I happen to be using 1995 through 2015 to sort of mimic the MFS chart that I was just simply showing. So the way this set up in the data that we pulled, which is utilizing the SBI S&P 500 total return at 100% of the portfolio, that average rate of return on this way that we're viewing it is 11.23% before fees, before taxes, before anything, okay? So when you look at this curve, what we're seeing is that the potential of the money, that $100,000, if it didn't have any market volatility, didn't have any taxes, it didn't have any financial pressure, it's going to get to about $863,000. And that's what people take to their spreadsheet. And they're like, oh shit, if I just put it in this fund, I'm going to have $863,000. Life is going to be great. And then what happens, okay, is there are taxes that are being paid out on the gains. And for purposes of the conversation, I just put the ordinary tax rate at, 37% and the capital gain rate at 20. And what's interesting is in this model, instead of compounding the money and paying the taxes from my earned income, I'm actually pulling the tax numbers out of the account every single year. So every time I pay taxes, what happens? I get an opportunity cost, right? It's money that I don't get to work for me for the rest of my life. The government has it. And what we're showing is that potential has now dropped to around $560,000. So the taxes paid, now we can export this into an Excel spreadsheet and get really granular into what the actual taxes were. And I got to tell you, 20 years ago, the tax rates were a lot higher than 37%. They were 39.6. Capital gain rates were higher. They were 28. Okay. So I'm actually showing a very low tax environment here. And what you don't know is what the taxes are going to be tomorrow. You just don't know it, right? And we're going to get some tax experts on here. We're going to go through this. But as I look at this, that same inflection point is got an outcome of $566,000. And if I liquidate the portfolio, there's another $40K of taxes. So I'm down to about $520,000 of output, where my spreadsheet, I thought I was going to have $830,000. I was feeling like I could go through this. Then there's the thing called management fees. And management fees, and I only have a 1% management fee in here. There's, most of the time when we look at portfolios, between internal expenses, external expenses, program fees, layer fees, trading costs, blah, 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 fees are often much higher. And there's trading fees that are even undisclosed in certain products. But that has now dropped it down to $454,000 and another tax liability of $34,000. So that fee drain has also cost a plan. And the problem is not the fees. The problem is not the taxes. The problem is the strategy in which we deploy in the compounding. Compounding, the eighth wonder of the world or seventh wonder of the world, whatever, compound interest is extremely powerful. But with it comes compound taxation, compound fees. And we haven't even talked about market volatility yet, right? So this is why what I'm saying is money is not math, money is a commodity. And if I now layer in the volatility, because I've actually never, and if you're watching this online, I'm hitting this volatility adjusted returns. This does not capture intra-year volatility. It's only capturing whether the market was negative at the beginning of the year or end of the year, okay? And I think what's really interesting is that same 50 inflection point has now dropped you down to 352,000. So you're in the market. Your calculator says you're going to get 11.52, or past performance says the average rate of return is 11.52 or 10.2 or 10, whatever. And the volatility adjusted returns, the taxation, and the fees have basically taken $500,000 of your money in strategy. Your wealth is under attack. It was one of my first books that's no longer being published. You might be able to find it. It was called 5 Ways Your Wealth is Under Attack. The new book, It's Your Wealth, Keep It, dives really deep into this. You can get it on Amazon. You can go on our website and request a free copy. If you book one of our Wealth Curve conversations and you keep it, we'll send you a nice copy. Okay? Free, no obligation. Okay? But I want you to think about this for a second. The volatility adjusted return is now down to 7.7%. My expectation, I was getting 11. And you got to know that what I'm showing you is not the full picture, because it's calendar year. It's not the right tax rate. If tax rates go up, what happens to this strategy? It becomes worse. If the fees are higher, it becomes worse. But then what I can't really get into your brain in this conversation, but if you're looking at this chart and you're 34 years old and you've grown your 100,000 to 260,000, and you're going through that 2000, 2001, 2002, 50% downturn, and you're now eroded back down to $156,000. You just lost a third of your money. You've hired the worst financial advisor possible. All right? And you go to cash. And if you look at the chart, now you have a ride all the way back up that you are missing. And that's the essence of that Dalbar study. I'll get back in when it feels good. I'll get back in. And why am I talking about this, right? I'm not 100% sure, but if you're still listening, I'm really happy. No, I'm going to tell you exactly why, okay? The power comes from the strategy, not the market return, not the thing. It's how I minimize all those effects and the impacts of the erosion. I could have the greatest financial products in the world, and all of the market volatility and all of the eroding factors, descending upon your wealth will take it away. If you have an eye and a focus on how do I minimize taxes during the accumulation phase and on the distribution phase, how do I minimize fees, how do I minimize the impact of market volatility, and how do I weather the storms, because they will come, is the key to your success. And if you focus on, okay, here's what I want, this is the goal that I want to get, and I build the right foundation for my plan. Like, you could be sitting right now working for a corporation, bored out of your freaking mind, and you have a great idea that you want to go out and build your own business, but you don't have enough capital. You don't have enough this. You don't have enough that. You have all these reasons. Your wealth curve could be substantially better if you took those actions. But you need to have the right plan to solidify in your brain that you have the permission to do this. That's what we do. That's what I want you to get from this. I want you to get that it's not about what a rate of return is. It's about how you structure and how you look at your money and how you think about your money and how you nurture it and how you grow it. That's the power. This is John Smallwood signing off. Really great to talk to you. It was a lot of fun. Thank you.